Afternoon, and welcome to the first quarterly webinar of 2016 in an educational series brought to you by Nasdaq and Brown Flynn. My name is Marissa Bridle, Associate Consultant and Marketing Manager for Brown Flynn, and I will be giving you a brief intro to the webinar as well as logistics. Today's webinar topic is Proxy Season and ESG Activism, What Issuers Should Know. We have Evan Harvey, Director of Corporate Responsibility for Nasdaq, and Mike Wallace, Managing Director for Brown Flynn. We are joined by special guests Aaron Bernstein, Editor of Global Proxy Watch, Meg Voorhees, Director of Research for US SIF, and Tim Moen, Senior Director of Corporate Responsibility for AMD. Just some webinar logistics. All registrant phone lines are in listen-only mode during this presentation. If you have a question, you can type it in the Q&A box at any time during the presentation, and we will answer questions during the presentation, a few of them, as well as a Q&A session afterwards. If you are experiencing any technical difficulties at any time, please dial either of the numbers on your screen. In just a second, I will turn it over to Evan for the formal welcome and overview of our webinar series. Then we will hear from Mike, who will be moderating the webinar today, and our panel of experts, and end with the Q&A session moderated by Mike. And with that, I will turn it over to Evan. Evan?
Thanks, Marissa, and good afternoon, good morning to everyone on the call. Pleased to welcome you to the latest in an ongoing series of informative webinars focused on sustainability and related topics, primarily designed for the Nasdaq issuer audience, but we obviously invite everyone who is a stakeholder in the investor issuer process and cares about these issues to join us and share their expertise and or learn. So the focus today, as Marissa said, is on proxy season and ESG activism, trends, what's going on right now. As you read in the introduction, activism surrounding ESG issues has grown significantly over the last few years. Proxy access, for example, is going to be on 100 AGM agendas this year. The uptick started really in 2015. The share of S&P 500 firms with access provisions has gone from 2% to 20%, so this is a significant issue in the space. But beyond that, just in terms of general shareholder engagement, we have a preponderance of the shareholder proposals out there in the world that are related to environmental and social issues. By some measures, 45 to 50% of all of the shareholder proposals are related to environmental and social issues. A very close number, perhaps a bit less, are related to governance-related issues. And then there are 10 to 12% that address compensation topics in particular. So these are issues that are prevalent in the space that IROs and GC offices and lots of other workflow teams at corporates are having to deal with on a yearly basis. So we assembled this call when we put together experts from a lot of different quarters to discuss how things are going, what they're seeing in their analysis of the field. We have very pleased to have Meg Voorhees as the Director of Research at the US SIF, which is the Forum for Sustainable and Responsible Investment. Aaron Bernstein is the Editor of Global Proxy Watch and an excellent sort of analyst in terms of trends and what's going on in the field. Tim Moen from the corporate side, he's Senior Director of Corporate Responsibility at AMD, a very similar role to mine at Nasdaq. I'm the Director of Corporate Responsibility for the Nasdaq stock market. And then we have our fearless moderator, Mike Wallace from Brown Flynn, who's going to set some of the stage, walk us through a couple of slides, and then kick off the conversation so that we can get into Q&A. If you have questions for us, feel free to use the chat function, but we would like to get right into the discussion and the presentation now, so I'll turn it over to Mike.
Thank you, Evan, and thanks to Nasdaq and all of you on the call today. Really appreciate your involvement in this effort. As Evan alluded to, we've been doing this series with Nasdaq for just over a year now. It started initially in December of 2014 with a webinar with Microsoft to talk about not only their own reporting efforts, but also what they're doing with their supply chain. And the next session we did was with BlackRock and Bloomberg, talking about how the markets are looking at data and using that data to make investment decisions. Then to help companies along the way, we had a session with the major frameworks that are out there in the world, the frameworks that are driving sustainability and corporate responsibility reporting. So the Global Reporting Initiative, International Integrated Reporting Council, and Sustainability Accounting Standards Board were on that webinar. And we then had a session on human capital and with Harvard Business School, Harvard University, and Aaron, who's on here today, was part of that webinar talk about the connections between ESG, corporate performance, and human capital. And we ended the year with a session with the World Business Council on Sustainable Development and connecting some of their work along the Sustainable Development Goals and work that was going on around COP21 and the lead up to COP21. In the way of today's conversation, we've got a great panel that's going to help us explore this area of proxy season and ESG engagement. If you can go to the next slide, Marissa. As we're going to unpack this story in a way that allows you to see the dynamics of the marketplace in a way that hopefully gives you a sense of how to move forward. We're going to have Meg Voorhees talk from US SIF, a professional association of investors. And then we're going to hear from Aaron, and he's going to tell us all about the proxy season activity of this particular year. And then we'll get closure from Tim Moen, who's going to explain how a company like AMD can do all that it's been doing. What you need to realize right now is there's numerous coalitions of investors that are grouping up around these topics, and US SIF will explain some of that. But literally internationally now, these are some of the leading initiatives that are out there representing trillions of dollars of assets. The common denominator amongst all of them is they're seeking transparency from companies on this thing called ESG performance. The next slide lets you see a little bit more about what this thing called ESG really is. In the grand scheme of the world of reporting, the Global Reporting Initiative is the most widely used framework out there in the world, and if you look at the Global Reporting Initiative's guidelines, you'll see a number of topics that they've outlined. And this is what encapsulates the broader term of environmental, social, and governance performance. When Americans particularly think about sustainability, they generally think just in that upper left-hand box, the environmental box. But as you see here, some of the world's leading companies are now being transparent on a wide range of topics, from economic to social to human rights and governance. And we're going to get into the nitty-gritty details of this in a second. I'm going to pass it over to Meg Voorhees now. She's going to explain to us what a particular group of investors is doing through an organization called US SIF. Meg, over to you.
Great. Thank you so much, Mike. I'm so pleased to speak with all of you today and pleased by your interest in shareholder activism on ESG issues. So in my remarks today, I will be providing an overview of the U.S. investment market segment that is focusing on environmental, social, and governance issues. And another label for this type of investing is sustainable and responsible investing, or we can throw in even more syllables and call it sustainable, responsible, and impact investing. And so to avoid all of those syllables, I may just use a catchphrase of SRI to refer to this segment. But first, let me introduce you to my organization, US SIF, the Forum for Sustainable and Responsible Investment. Next slide, please. So we are the leading voice advancing sustainable, responsible, and impact investing across all asset classes. Our mission is to rapidly shift investment practices towards sustainability, focusing on long-term investment and the generation of positive social and environmental impact. We have about 330 firms and organizations as our members, quite a few investment management firms, some asset owners, and then a range of organizations that provide services to the SRI field, these investment consultants, financial planners, and advisors, research firms that specialize in corporate ESG indicators and doing that sort of work. Much of our work is supported by a 501c3 organization, the US SIF Foundation, which carries out many of our educational and research activities. And I've put our website there so you can see more about our news, our policy statements, the agenda and speakers for our annual conference coming up in May. And we also have an education center. We provide an online course for financial professionals to introduce them to sustainable and responsible investing. And we have a wealth of research and publications that we offer. So in fact, our flagship research report is a biennial survey, and I've got the cover there up on the slide of our most recent survey in 2014. So every 2 years we conduct a survey through the US SIF Foundation to determine the size and scope of SRI investing in the United States. And these institutions and money managers that we review are practicing SRI. They seek to achieve competitive financial returns over the long term, but they also have some other objectives they're trying to meet. They want to invest in a way that's in line with their values or their clients' values. They want to minimize risk from poor ESG practices on the part of their portfolio companies, and they may want to realize investment opportunities related to ESG issues. So there are two broad ways to practice SRI. One is what we call ESG incorporation. So this is the consideration of environmental, social, and governance criteria in deciding whether to add or keep investments in an investment portfolio. And the second way, which we'll be discussing more on this call, is by filing shareholder resolutions at publicly traded companies to improve their ESG policies. So for our most recent trends report, which the one published in 2014, we researched the activities of 630 money managers and nearly 1,600 institutional asset owners, such as retirement plans and foundation endowments. Next slide, please. And here's what we found. We found that sustainable investing took a significant leap forward from 2012 to 2014, if you look at the last two bars on that chart. In dollar terms, it grew by 76%. And if you look at, you'll see three different colors. So blue represents the assets that are engaged just in ESG incorporation. The orange band represents the assets that are just involved in filing shareholder resolutions. But we also see a number of assets and investors that undertake both strategies. So the assets are involved in both, and that's the green bar. So another thing to notice is that from 2012 to 2014, SRI captured new market share. So for much of the decade through 2012, SRI accounted for a fairly consistent 10 to 12% share of the overall market of professionally managed assets in the United States. But in 2014, that leaped to 18% of the overall market. So in other words, more money managers and institutional asset owners are practicing SRI, or they are applying SRI strategies to a broader portion of their assets. And we also ask money managers, why they engage in ESG incorporation or shareholder activism, and the biggest driver for them is client demand. So let's look a little more closely at those 2014 findings. Next slide, please. So here you see that if you look at the large blue circle, a net $6.2 trillion as of January 1st, 2014, was held by 480 institutional asset owners, 308 money managers, and nearly 900 community investing institutions in the United States that practice ESG incorporation. The smaller orange circle represents the net $1.7 trillion at the start of 2014 that was held by about 202 institutional asset owners and money managers that collectively filed hundreds of shareholder resolutions on ESG issues at portfolio companies. And since there is overlap between the two strategies, as we discussed with the earlier slide, that amounts to a net $6.6 trillion practicing one or both of these SRI strategies. So filing shareholder resolutions is an important tool for investors for advancing change at publicly traded companies. And in the United States, it's a relatively accessible strategy for most investors. The basic requirements are that would-be filers of resolutions need to hold $2,000 worth of stock in the company, and to have held that $2,000 minimum for at least a year as of the record date, which is usually about 6 to 8 weeks before the annual meeting. And under the rules set by the Securities and Exchange Commission, a proposal that consistently gets the support of at least 10% of the shares voted can be refiled indefinitely, assuming the resolution meets the overall requirements for proper subject matter and does not become moot over the time period. Investors today now file about 50% more shareholder proposals on environmental and social issues than they did a decade ago, and there were more than 400 that were filed in 2015. In the environmental and social arenas, concerned shareholders have focused particularly on improving disclosure and oversight of corporate political spending, of environmental policy, especially with regard to climate change, and overall sustainability. When you think about the chart that Mike was showing, those would all be counted as sustainability indicators. Requests for disclosure often have a broader objective. Investors are interested in the data they get, but they also believe in the rule that what gets measured gets managed, that it's a way of bringing an issue to the forefront for portfolio companies and helping ensure that companies focus on something and perhaps make it a strategic objective. As Evan mentioned, on the governance side, the big story in 2015 were the number of shareholder proposals filed on proxy access and their success in changing company policies in this regard. And then I want to put this all in a broader perspective. So let's look at the next slide. And the broader perspective is that growth in sustainable investing is not happening just in the US, but it's a worldwide trend. So in partnership with sustainable investment organizations around the world, we published a 2014 review of global sustainable investment. And as you can see, there was average growth of 61% from 2012 to 2014 in the 5 regions we covered: Europe, United States, Canada, Australia, New Zealand, and Asia. And so now here we are in 2016, which means that we at US SIF survey of SRI trends in the United States. Our results are, and I won't be surprised to see further growth in the dollar value of SRI and perhaps its market share. And I think issued updated guidance for retirement plan fiduciaries who are subject to ERISA. The new guidance states that, quote, fiduciaries need not treat commercially reasonable investments as inherently suspect or in need of special scrutiny merely because they take into consideration environmental, social, or unquote. And it replaces a 2008 bulletin that had implied that no legal scrutiny if they considered environmental, social risks and opportunities in assessing potential investments. So I think that gives SRI and ESG investors a sense that the wind is at our backs. So thank you. I'm going to turn things back over to Mike to introduce our next speaker. Thanks.
Thanks a lot, Meg. That's a great introduction as to what's going on out there. As a consulting advisory firm that works with companies on corporate responsibility and sustainability governance, we often hear from the investor relations officers this activity going on out there. They've seen presentations like what you've just shown us, but they don't hear a lot from their investors. Can you talk to that point that is brought up so many times out there in the marketplace?
Yeah, I think it's true that even though there are more shareholder resolutions being filed, they do tend to be concentrated at a a smaller number of companies, and I think that probably gets to, they're probably being filed at the most widely held companies, and that probably, I'm sure the vast majority of companies are not seeing these issues being raised by their investors.
Okay. Another question that's come in is one related to your organization. There's a lot of organizations kind of like it, and one of the slides that I showed had a number of other organizations. How does SIF collaborate or work with, or what are the other organizations out there that someone who's listening in today that's not familiar with this field should be paying attention to?
Okay, yeah, we do work with and collaborate with a number of the other organizations. I've seen US SIF described as the complete ecosystem of sustainable investing in the United States. So some of the other organizations that you have on your chart would be more focused on a particular aspect of SRI investing, or a particular segment of the market. So, for instance, the Interfaith Center on Corporate Responsibility is largely faith-based organizations, and they do fantastic work. They do a lot of work on shareholder resolutions. So they do some work that we don't do, or they have a specialty that we don't have. Many of our members are also members of these other organizations. So when it makes sense for us to collaborate, we do, and to recognize that another organization may have a particular specialty, we will, let them lead and support them.
Great. Thanks, Meg. And so for those of you on the call, we are recording this. We also have the platform available where you can write in questions. We can't hear you. Everyone's on mute because of the number of people on the call. The organizers themselves can talk, and the presenters can talk. Another question that's come in is around the collaborative style that SIF represents when it comes to corporates. I know from being a member of SIF that there you have a lot of webinars and calls with companies. You seem to have a very proactive engagement style. Can you explain a little bit more about that and why that even exists within US SIF?
Okay. Well, US SIF as an organization is not particularly involved in direct engagement with corporations, but certainly many of our members are. Certainly as a membership association, we need to be mindful of, representing the range of our investors and members, supporting their activities where, as we can through education, through our work with media, through research. But we will often defer to our members who actually, own the shares in companies to lead particular corporate engagements. One area I'd like to mention, though, is many of our members are research analysts who focus on corporate responsibility issues, and for years we've organized informational meetings with companies to discuss their sustainability efforts. And the advantage that we can bring for these companies is that we are gathering a lot of the research analysts from various research firms and SRI firms kind of in one telephonic room to hear their story and to allow them to ask questions of the company. So we, and we will be continuing to do that, organizing these company calls.
That's great, Meg. And for those of you on the call from companies who are just in the early stages of understanding this area, realize that a group like SIF is a great platform to get your story out. We've taken some clients to that platform, and like Meg just mentioned, had the investor relations officer and perhaps the chief sustainability officer have a dialogue with these types of investors. It's quite a constructive way to get engaged with this community, and these are long-term shareholders. So we're going to transition over to Aaron Bernstein, editor of the Global Proxy Watch. So I want to have Aaron introduce himself, but also just timely as it is, today was a release of some news about ExxonMobil in Reuters and how Exxon must now allow climate change vote, apparently according to the SEC. So that just popped this morning, and Aaron, this is the area of your expertise, so we'd love to hear more about you and your work and what you're finding out there in the way of the dynamics in the market this time around.
Okay, thanks a lot, Mike. Yeah, so I write Global Proxy Watch, which is a weekly newsletter on corporate governance that has been running for, this is now our 20th year, and we're read by investors and corporates in most of the advanced markets, North America, Europe, and the Asian markets. So we try to keep track of global trends in corporate governance. I also separately am a non-resident fellow at a program at Harvard Law School called the Pensions and Capital Stewardship Project, which works with pension funds and I do work there to help pension funds, but investors assess long-term ESG risk. And as Mike mentioned, I did a paper last year on human capital materiality. We have a project going on that. So I do sort of long-term research as well as weekly kind of more news-oriented analysis of the global trends, including the US market where I'm based. So the first slide, we thought I would talk about proxy access, which Evan mentioned is sort of one of the big issues this year, as it was last year. In terms of ESG activism, that and climate change are probably the biggest on the agenda this year. There's certainly perennial topics like executive compensation that will be talked about in political spending, but proxy access in particular just came out of nowhere last year, as this slide suggests, and it has been rapidly adopted. Everybody just sort of seemed to agree that this was the right thing. It's something that most other markets, shareholders have the right to nominate candidates to the board in one form or another. In Italy, they have the voted lista, and everybody has a different system. The US really doesn't, except for having a proxy fight that costs millions of dollars and is very adversarial. So finally, it looks like after some years of debate with the SEC, both investors and companies have agreed that this is a good way to go. So we will see a lot more of that, as you'll see on the next slide. There's been a lot of debate about how to do it, and this is the 3% standard has sort of become the norm, as you can see from the table here. That's pretty much what everybody has agreed to. The SEC proposed a rule on this that you all may remember a couple of years ago, where they used a 3% standard, which means you'll have to own 3% of a company before you can have the right to nominate somebody on the corporate proxy. The SEC rule didn't get put through. The business lobbyist, business community sued the Business Roundtable and the U.S. Chamber of Commerce, and they prevailed in court, and they prevented the SEC from promulgating that rule. So it's now been left to investors and companies to do it individually on their own, but they settled on the standard that the SEC articulated in its in the rule that was struck down. So on the next slide, you'll see that that's the same kind of thing is going to happen this year. There are even more proposals. These numbers are as of this week that the ISF provided, 192 proposals on access. Most of them are on 3%, the same sort of standard. You'll see that 50 are withdrawn. Most likely that means that they were withdrawn by the investor who put them in, because they had conversations with the company, and the company agreed to, adopt proxy access in some form or another through a bylaw change or something. We probably won't know that for a while, but it's very likely that a lot of are being put in, and of course, a lot of the 192 is most likely to see the same kind of outcome as last year. So I would anticipate that by the end of this year, we will have proxy access in a much larger percentage of both the S&P 500 as well as smaller issuers. Having said that, I don't expect very many, if any, actual board nominations. In other words, investors have fought for this right, and they don't really plan to use it. And that is largely because both investors and companies would perceive it as essentially a proxy battle, even though it would be on the same proxy card. If a big pension fund or group of pension funds nominated somebody, that candidate would be up there with the board slate, but the company would see it as a threat. They would take it as a threat, and most investors, even though they are willing to vote for the right to have proxy access, they're not ready to actually use it. So I don't think we'll see very much use of it. That will come at some point, but right now I think most investors that I'm aware of in the U.S. see this as a way to basically open the door for them to have conversations with a variety of board topics. In a way, it's sort of analogous to the say on pay proposals that started a few years ago after they were mandated. And there are votes, of course, and companies do have their say on pay proposals voted down, but it's a very small number as a percentage of the total market. But instead, it has facilitated conversations. So companies don't want to have their pay packages voted down by their investors, so they have discussions with investors about how to structure them and what they might want to see. So that has been already going on with proxy access in the last year. Boards have been having conversations about a wide range of issues that investors come to them about. Climate competency on the board is one big topic, but there's a lot of other diversity, of course, is another big topic. Women on boards has been a major issue around the world, a lot less so in the U.S. actually, compared to Europe and other markets. But that's a topic of concern that's growing here. There's more pressure on it, and investors are going to boards and saying, we want to talk about these kind of issues. The proxy access, if it's available in a company now, it's sort of a threat looming in the background that prompts the conversation. So that will continue to be the case this year. The other major issue, as I said, is climate change, and those two are related in the way I just said, which is there's a lot of proposals on climate change in terms of board oversight, board competency, which relate to proxy access in the sense that the conversation takes place in that context. If you go to the next slide, you'll see that separate from the proxy access, climate change, also there's been a big uptick, not nearly as much, but quite a big growth in shareholder proposals this year on a variety of climate-related topics that has been spurred by the COP21 talks in Paris in December, which has really focused global attention on long-term climate change risk in the investor community and amongst corporates. So that is going to be a big topic of conversation and shareholder resolutions this year. What's less clear is how much support they will get in actual AGM votes. So there's a range of topics, like board competency is one. Should a company have a policy on climate change risk oversight? There's lots of different proposals out there on climate change. There's not a lot of consensus yet on the investor side, and if you'll turn to the next slide, you'll see that some data on voting on climate change proposals last year, which basically shows a real split. Can you go to the next slide? Or I had a chart there showing the split. There we go. So this is something that Ceres put out last week, and it basically looks at the largest U.S. mutual funds and how they voted on I think it was maybe 80-something climate change proposals last year. And as you can see, there's a wide diversity of opinion. Big asset managers like Deutsche Bank voted for like almost every single one. And then you have 8 of the biggest funds, BlackRock, Vanguard, Fidelity, that voted for not one. They didn't support any of them at all. That is mostly because those big funds say that they think climate change is a very important issue, and they want to have conversations in private without pressuring the board through and management through negative votes. For instance, BlackRock has been a leader on climate change. They're a member of Ceres and the Investor Network on Climate Risk. They're members of every climate investor organization there is, but they vote against every single resolution. So there's pressure on them, on the big mutual funds, to vote more in favor of climate change. And there's a pressure from COP21. There's also explicit pressure from their shareholders because they are publicly traded companies, and a number of them have had shareholder resolutions asking them to disclose their votes or to explain their votes, why they vote on either climate change and or ESG issues in general. This has happened at BNY Mellon. This has happened at a number of companies where they say, you've signed the UN Principles for Responsible Investment, and yet you vote against every ESG proposal. Can you explain why? Those proposals haven't passed or haven't gotten much support, but it puts pressure on those funds to, at the very least, explain why they're not voting for something that they say they support. So there will be more pressure like that, and BlackRock this week filed its proxy statement, and there is a proposal from a shareholder to have them disclose their votes specifically on executive compensation, but it's sort of the same logic, saying you claim to be a long-term investor and yet you vote in favor of management on every single executive compensation proposal. Can you please explain that? That there will be, I don't know how much support there will be for these climate change proposals, because those companies have long-standing policies of engaging in quiet diplomacy, and they don't like voting against management. So we'll see how that goes. You know, having said that, companies like Exxon, like Mike said, they just they've resisted. I mean, they're sort of a good example. You know, they have resisted a proposal that was put in for the board to assess the economic consequences of climate change on the company. They said, we already do that, we don't need it. They tried to exclude it from their proxy. The SEC on Tuesday filed what's called a no action letter, which said, you know, you can't do that. Well, not literally you can't do it, but you would be unwise to do that. So it will most likely end up on the proxy. I have my doubts whether companies, you know, these big mutual funds that hold a big chunk of the market here, like Vanguard and Putnam and ING, I don't know if they'll support that.
Okay.
So that is an open question.
So let's have a quick little recap. We got 20 minutes left in the call. A lot of people on the lines today. Please do feel free to write in your questions. We are recording this, and we will send out the presentation in the recorded form and as a PowerPoint later on. Evan, a quick question back to you, because you had mentioned earlier in the prep for this that you too had gone through your own shareholder engagement activities. Can you explain a little bit about that? And maybe you actually have some of your own questions for Aaron, given the dynamics that he monitors so closely.
Yeah, Mike, two quick things. So, you know, I know firsthand, as Nasdaq is not only just an exchange, we are our own public company listed on the exchange, and we go through the investor engagement process on a variety of topics like any other public corporation. And we have been through the shareholder process related to ESG before, successfully negotiated it, and sort of took the attitude from the outset that proactive engagement and starting a conversation that actually talked about long-term goals and how we were going to address things like resource constraint and supply chain management. You know, were important issues for us, even though we are not a manufacturer. We don't have a particularly large footprint, but we do have a supply chain, and we are a manufacturer of technology and software, and so it does make a difference. And so that sort of experience leads me into a quick question for Aaron. You know, he's been doing Proxy Watch for 20 years. Has he seen a general shift? I mean, underlying all of these webinars is sort of this prevailing undertone of engagement, transparency, having an open conversation with investors that you want to attract, being more vocal about your strategy around environmental, social, and governance practices is generally a positive thing, has lots of correlated outcomes that are positive, financial and otherwise. So I wanted to ask Aaron, looking at the field with Proxy Watch for the last 20 years, has he seen a general shift in the attitude of corporates these exceptions like Exxon notwithstanding, towards more engagement style, being more open, more of a conversation that is collaborative more than adversarial?
There's a lot of movement in that direction. There's still, I think, a lot of uncertainty in a lot of big companies about how to handle engagements from investors. There's Reg FD concerns, for one thing. I don't know how serious that is, but they talk about that. There's also kind of the mismatch problem that we referred to earlier, which is, investors have to prioritize who they talk to, so they tend to talk to the biggest companies, but a lot of companies, when they want to talk to investors, the investors they don't want to talk to them, and vice versa. So there's just kind of that's a sort of a dynamic that's a bit difficult, but in general, there's better conversations and more understanding, and I think part of that is because there's been a shift. There's a lot of reasons. There's been a shift in a lot of sort of global conversation. There's a lot more engagement going on around the world, particularly in Europe and the UK, where regulators and market leaders are explicitly telling investors, you have to engage with companies. It was a big response to the 2008 financial crisis in Europe, where the regulators said investors have to start engaging and companies have to start listening. And a lot of those companies, of course, are big global companies, including those in the US. So they're hearing it elsewhere. So that makes the conversation with US investors, I think, go a little bit easier in terms of opening the door. Having said that, there's still concerns.
Yeah, thanks.
Yeah. That sets us up nicely. And it's nice to hear the reality of it from Nasdaq as well, having gone through that. And Evan hasn't had a chance to really explain his bigger role, but we'll get to that towards the end. We've timed this quite nicely. We've gotten 45 minutes in. We've got 15 minutes left. Tim Moen's here to explain a little bit about what's going on at AMD, and it's meant to be presented to you all, the companies out there that are tuning into this, trying to understand what's going on in this world of ESG, sustainability, corporate responsibility, whatever you want to call it. What we notice with the conversation today, and what we're also seeing in the market dynamics too, is that companies are generally getting hit with some sort of question from an outsider. If they're publicly traded, it might be coming from a shareholder or one of these groups we've mentioned earlier, and you might scratch your head and say, what am I going to do with this? And you might not do anything with it. There's an entire ecosystem behind the scenes that's monitoring whether or not you disclose information or not. Carbon disclosure is one of the big ones. Moving further along, the broader ESG and GRI type of disclosure comes up a lot. We're in the midst of reporting season right now, so a lot of companies are doing their reports right now. And also Robeco Sam and the submissions for DJSI are out there right now. So you might see these types of things coming up in front of your own corporation. So with that, I'm going to pass it over to Tim Moen, who's been in the industry for a long time. He's in his quiet period right now with AMD, but he's been granted permission to be on here to talk about what they've been doing and also what they've been doing when it comes to engagement. Tim, you want to tell us a little bit about your role and your background and take us through what you do at AMD?
Sure. Thank you, Mike. Good morning, good afternoon, and good evening to everybody. I can see that we have a number of people on the webinar. With the short time we have remaining, let me try to be really efficient about this. So if we can go to the next slide. I'll let you this on your own, and of course this is all on the website, but just to give you a brief introduction, AMD is a leading semiconductor design firm. Most of our products are in products that you know, such as personal computers, tablets, game consoles, and servers. If you go to the next slide. I just want to give you a very brief background on corporate responsibility here. I do lead this function for AMD and have for a number of years now, but even prior to me getting here, this is sort of baked into the DNA of our company. We have issued now 20 consecutive years of corporate responsibility reporting. We're deep into our 21st. And so there's very few areas of this subject matter that we haven't delved into over all of those years. I've also included on this slide some of the recognition that AMD has garnered recently for our corporate responsibility efforts. And just notably, some of these come from the investment community, such as Calvert, MSCI, IRCOM, Dow Jones Sustainability. Next slide, please. Now to the subject at hand. I just want to briefly give you sort of 2 points about working with social investors and analysts that come from these many years of experience that I mentioned before. So first is proactive, and obviously the next will be reactive. On the proactive side, some of the things that we've done here at AMD that have been productive for us is to meet with our stakeholders, which includes socially responsible investors and analysts, in a formal stakeholder engagement panel that's run for us by Ceres, which has come up already on the call a couple of times. Very great organization. If you don't know about them, you should look them up. In this panel, we are very open, very honest. We outline our progress and our plans on corporate responsibility. We talk about changes in our company and what that means for our CR or corporate responsibility programs. And most importantly, we listen. This is a two-way dialogue. We get a lot of feedback. We act on some of it, maybe not all of it, but it really does help us shape our programs. The next is a much more active form of engagement, the investor roadshows. We do this about once a year, working with our investor relations department. These are a series of face-to-face meetings where we actually sit down with the key investors and analysts. We cover two things. We cover the business, which is the strategy, financials, products, all of the things that a sort of mainstream investor would want to know about, as well as corporate responsibility, and we do a deep dive on that. And here again, this is about two-way dialogue. A lot of times we learn more than we give here. We hear about what investors are really concerned about. We hear about their concerns, criticisms about our own programs, and again, it's a very helpful guidepost for us in terms of running these programs here at AMD. And then finally, just general engagement. We like to attend conferences. I would mention Sustainable Investment Forum has a very good one. Carbon Disclosure Project, GRI, the Global Reporting Initiative, the Sustainability Accounting Standards Board. These are just a few of the various reporting standards that AMD and other companies report against. So we're constantly kind of putting information out there that help investors and analysts understand our company. And then finally, we do work with some individual analyst data collection and ratings that are sort of one-off and not standardized. So if we can go to the next and last slide, please. And then finally, reactive. We've been talking a lot about shareholder resolutions and proxy season and so on. And over the years, a few tips that we've garnered here at AMD that might help other issuers on the phone. When you get one of these resolutions, I think it's time to sort of take a step back, not panic, read it, understand what they're after, and then gather a core team that of course includes your legal department, investor relations, corporate responsibility, but most importantly, you want to gather the owners of the actual program that is the subject matter. If it was supply chain, for example, that might be your procurement leaders. You meet with this core team, research your programs, understand where your strengths and weaknesses are. Also, we've reached out to other companies that may have received a similar or identical shareholder proposal in the past and develop a negotiation strategy. At this point, we usually reach out to the filer. We have a first meeting. That first meeting is really to listen and to hear kind of what their thoughts are on a high level, and then have subsequent meetings where we can sort of dive into what are the issues and things that we can do that might not be being done now, that might help them feel good about the progress and programs we have at AMD and lead to withdrawal of the resolution. In most cases, this can be achieved through dialogue, discussion, and negotiation without kind of reaching into the adversarial bag of tricks. Last thing I want to say is very important. Once this is all through and we've reached withdrawal settlement, it's very important that the terms of that settlement are incorporated into company management systems. Unless we have, a person, a date, and a deliverable, it's easy to kind of lose track of these things as the years go by. So with that, I'll sort of close. I know we only have 10 minutes left in the webinar, so I'd love it if we could get into some more interactive discussion.
Thanks a lot, Tim. That's great, and definitely have some questions for you, and then we're going to also get some back and forth with the other panelists as well. Again, feel free to write in through the platform. If you've got questions, you all are on mute, so we can't hear you that way. Tim, a couple of things come up when I look at the list of participants that are here and their titles and organizations. These are people that are tuning in. They're probably not in the same kind of role that you're in right now. Can you give us a little bit more history of your background in the electronics and industry and how these things came up for you over time? It's not just the shareholders. There's other players out there asking you questions, including employees and customers. Can you give us some trajectory of your history?
Yeah, thanks, Mike. Yeah, I've been in the corporate responsibility field within the tech sector for over 20 years at Intel, Apple, and now AMD. And over those years, this whole field has grown. Yes, you're right, Mike. These questions about environmental, social, and governance come from many different sectors, increasingly from our own employees, certainly activists of all stripes, and our management. Most of the managers truly do care about these issues. But when it comes to shareholders and specifically resolutions, what we found over the years is, and I said this in my remarks, is there's no substitute for dialogue. I think we were talking about this earlier in the webinar, but frankly, most companies these days, I think it's some 80% of the Fortune, the S&P 500, are publishing sustainability reports. So many companies have a public persona, public profile supporting the very issues that are in the resolution, making it incredibly difficult to ask their shareholders to vote against such a resolution without inspiring a lot of confusion. And so in our history, it's best to reach out to the filers, to have a negotiation so they can understand our programs, we can understand their needs, and oftentimes we put into place some programs that can satisfy their concerns.
Great, thanks for that, Tim. Another question for you, Tim, related to what we've heard today from these organizations, US SIF and Global Proxy Watch. Do you use this kind of information yourself to help make the business case internally, and do you draw on this type of research, or is your head down just trying to plow forward to the next report?
Oh, we use it all the time, Mike. It's a great question. I mean, the growing trend in socially responsible investment is something that I think, almost every IR department is looking at, and if they're not, they should be. These are very important investors, and their concerns are ones that we take seriously. In terms of building the business case for corporate responsibility, I write a lot about this in my book, Changing Business from the Out. We're constantly being asked about our return to the company. One of the biggest areas of return is to work with investors and analysts. These are the people who own our company. Their concerns are very important to us, and so by all means, it's a big part of our return to the company.
Thanks, Tim. We got 5 minutes left. I've got a couple of questions that have come in, but I will go back to Evan because I think we want to touch on a couple of things, Evan. One is you're not just hosting these webinars to educate people. You actually have to do this stuff yourself at Nasdaq. But then on top of that, you're also working with the World Federation of Exchanges and the Sustainable Stock Exchange Initiative. I think the audience could probably use a little bit of a glimpse of your world, if you wouldn't mind sharing some of that.
Sure, I'll go quick. For those of you who don't know, there's two significant exchange-centric projects going on that are focused on ESG transparency at corporations, including the stock exchanges themselves as public companies in many cases. The United Nations Sustainable Stock Exchange Initiative has 50 exchange members. 50 of the 67 exchanges on the planet are members, and it's essentially now devoted to finding ways to forge collaboration between the corporate space and investors and ESG firms around attainment of the UN Sustainable Development Goals. And then we also have a group that we chair at the World Federation of Exchanges, our trade association called the Sustainability Working Group, which is working with 21 stock exchanges right now towards creating formal ESG guidance for listed companies. So some stock exchanges, primarily smaller markets, but not everywhere, are going down the route of creating a listing rule or a requirement for annual disclosure of environmental, social, and or governance metrics by listed companies. A number of other exchanges, such as ours and NYSE and others, are focused primarily on education and engagement with companies, trying to teach them the value of ESG disclosure and put them in touch with investors that have a real interest in this topic. These tend to be valuable investors for companies, pension funds, community banks, foundations, long-term holders. So there's a real value in being more transparent on this topic, short of being told to do it by the exchange. But the exchanges are just one part of the ecosystem. They're looking for data on this space. You know, we have a number of frameworks looking at ESG disclosure from corporates, GRI, as we mentioned before, CDP, IIRC. We have a lot of indexes that focus on this space, most prominently DJSI and FTSE for Good. We've got questionnaires that get to a lot of companies via their supply chain and RFP and procurement process. Government contracting is increasingly tied up with transparency and disclosure on ESG. Insurance companies are definitely taking a harder look at this. And then we have the question of third-party assurance and auditors looking at sustainability reports and other disclosures. So the ecosystem around disclosure, quote, of the non-financial metrics has ramped up significantly over the last several years. And exchanges are determined to be out in front and assist their listed companies in delivering what the mechanism of investment in their company and for their companies actually deserves.
Thanks, Evan. So I want to close the session off with some recommendations from each of you. So we're going to go down the line from Meg, Aaron, Tim, and then circle back to Evan. But what you all have heard today is this growing interest in these issues from shareholders, investors, getting to the point where they're actually increasingly engaging directly with companies. We've heard a little bit about how companies sometimes do engage and sometimes they don't engage. And we've heard directly from a Nasdaq-listed company about all the activity they've been doing for a long time and how it's actually helping to enhance their brand and help enhance their performance. So Meg, over to you. Recommendation for listeners who are primarily companies on the call. How would you suggest that they move forward with corporate responsibility and disclosure?
Okay, well, I think first of all, there are some resources to look into. I mentioned the US SIF website, www.ussif.org. If you want to see what's coming up in the 2016 Proxy season on environmental and social issues, one of our members, Sustainable Investments Institute, puts together a preview on the shareholder resolutions. You can find it at www.proxypreview.org. And I think more broadly, I would echo what Tim had to say about engaging with stakeholders who bring up concerns about ESG issues. I had a long career working for a research center specializing in investor responsibility issues, and I covered shareholder resolutions on environmental and social issues. And so many times I would see a company go to the SEC and try to figure out a way to fight a shareholder resolution, keep it from appearing in its proxy statement. And I would look at the company and what it said its policies were, and I would think, why is it fighting this? Why isn't it meeting with the proponents and seeing if they can get to yes, some mutual agreement that would lead the proponents to withdraw the resolution. So, you know, I definitely agree that engagement is a two-way street.
Thanks, Meg. Aaron, we're right on the hour, but give you a couple of seconds to wrap up with recommendations. Aaron must be on mute. Tim, over to you.
Yeah, I'll just follow up on what Meg said. Engagement over adversarial approaches works. You might find you agree on more than you disagree with, and it certainly saves a lot of time, heartache, and money. So I would heartily leave you with those words, engage.
Aaron, are you there?
Yeah, sorry about that. Yeah, I was on mute. I guess the only thing I'd add is I think companies are going to have to start paying a lot more attention to the ESG reporting as well as engagement, because there's just so much of it coming down the pike in the next year all around the world, and U.S. companies are going to have to wade through it and figure out how to do it.
And Evan, you want to close us out as also with giving us a recommendation what you think companies should be thinking about?
Well, I'm going to echo what Aaron just said. I think that reporting is an essential building block in this process for corporates. Not only taking the ESG information and getting the data that is asked for in something like GRI framework and using it in-house as a strategy tool, and figuring out where your inefficiencies are and figuring out where your risks are, and it's a great way to make your business better and to demonstrate stronger and more active data-driven management style and leadership. But I think that the reporting process is really valuable. It's another efficiency. The more you're able to push out messaging and data related to your performance on ESG, the less likely you'll have a lot of time or money or energy wasted in one-on-one engagements with stakeholders who care about this process. And frankly, you're going to create more avenues of opportunity with people like potential investors that you didn't even expect. So it bears fruit in a lot of ways if we're able to get that done.
Thanks a lot, Evan. Thanks, Tim and Meg and Aaron, for the time today, and for all of you for being here. We're going to distribute this webinar in a recorded version as well as a PDF of the deck. And you can tune in next quarter and join us for the next one. Thank you all.